Welcome everyone to Vested Interest. This is Shane back for a stock pick of the day video. It is Monday, March 17th. We're going to take a look at one out of the financial sector. This is Capital One. Before we get too far in the video, if you could do me a big favor, hit that thumbs up button down below if you find any value in the content. Make sure you are subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Click that notification bell down below so you're notified whenever I put out any new content. I do this stock pick of the day video series Monday through Thursday when the market's open. We take a look at a company stock that's pulled back on the day, run it through my screener, and see if it makes it onto my watch list. There's the thanks button down below. If anyone would like to buy me a cup of coffee and support the channel that way, that is an option also. And a special thank you to the viewers and subscribers of the channel. Really do appreciate it. The channel continues to grow because of people like you. A couple last things here. If you could watch the videos to the end, watch time is one of the metrics that the YouTube algorithm uses to show that you like the video. So watch as much of the video as you can and share with anyone you think that might find value in the content. Any other investors out there that you know might like this. Now this is the vested interest stock screener. This is the criteria we are going to be running through the video. It must meet 6 of 9 because it's a financial company, so we are going to look at price to book with 1 being fair value, right? So it's got to meet 6 of 9. A lot of the other ones we don't look at price to book because they're outside of financial sector. Today we will add that in. All right, back to Capital One. Check them out on their homepage, www.capitalone.com. That's www.capitalone.com. That is their homepage. And they are a bank, right? I mean, you know, Capital One, credit cards, checking and savings, auto loans, business loans, commercial, benefits and tools. I don't know that they have an investing arm. They may. You'd have to go to their website. I do not use Capital One. I don't bank with them. I don't believe I even have a credit card from them. I have several credit cards, but not a Capital One one. And about Capital One, more than 25 years ago, Capital One revolutionized the credit card industry with data and technology. Today, we are one of the most widely recognized banks, or one of the widely recognized brands in banking, serving more than 100 million customers across a diverse set of businesses. So they're a large bank, you know, like a Bank of America, any of the other banks out there. And you're probably well aware of them. You see the Capital One, you know, what are you holding in your wallet, I think is their big tagline when you see their commercials. Or what's in your wallet, I think is how they say it. But the reason we are taking a look at them, down 3.85% on the day, we are talking about Capital One Financial Corporation, ticker COF, out of the financial sector, closed up the day at $165.26. Looks like they're slightly down a little bit more in the after hours here. 52-week range as low as $128.23, as high as $210.67. They are not quite within 15% of a 52-week low. They need to be around 147 or lower whenever I did the math there. A market cap of $63.018 billion, a beta of 1.48. So they are much more volatile than the overall market. Beta being the volatility of the market, 1 being the market. You can see that volatility throughout the day, right? Looks like they were pretty flat throughout the day. A little bit of a drop around 10 a.m. there. Looks like they tried to recover a little bit up until about 2, and then boom, big drop. Big drop from about 2 to 2:30, recovered a little bit, and pretty flat for the rest of the day. But that is the volatility that you're talking about when you talk about something that's more volatile at 1.48, so more volatile than the overall market for sure. PE ratio is $14.27 per share, but PE ratio is not really what you want to be looking at for a bank. You really want to look at price to book. We'll see that here in a second. EPS, earnings per share, $11.58 per share. Earnings date coming up in this window here, April 23rd through April 28th, so coming up at the end of next month. So it wasn't earnings that had them dropping today. Forward dividend is $2.40. I believe they're a quarterly payer, so divide by 4, though we will see that here towards the end of the video with a 1.4% starting dividend yield if you were to buy them now. Ex-dividend date, February 18th. Looks like they paid out on March 3rd. So if you were to buy them now, you would be in line for the next dividend, but you're going to have to wait a few months, right? This was just paid out at the beginning of March here, just a couple weeks ago. 1-year target estimate, at least according to Yahoo Finance, where I pulled this information from, $215.23. So they actually see it setting a new 52-week high, at least according to Yahoo Finance, not affiliated, just one of the sources I go to for information. Now, jumping over to the right, I like to look at dividend yield theory to see if the company is potentially undervalued. It's a quick check. To do that, we look at their 5-year dividend yield average, 1.74%. We compare it to their current 1.4, or forward over here where it says 1.4, same number, 1.4%. Since it is lower than their 5-year average, that actually speaks to overvaluation. Where they currently are is potentially overvalued, at least according to dividend yield theory. If this was higher than their 5-year average, that would speak to undervaluation. They are inversely correlated, right? Now, I do like the payout ratio. It's very low at 20.73%. I like anything under 75%, so that's very nice. Gives them a lot of room to continue to raise that dividend over time, pay down debt, make acquisitions, reinvest back into the company. They've got a lot of free cash flow left after they pay out the dividend to do that. And raise that dividend over time, which is what we want. Now, looking at price to book, again, 1 being fair value, you can see they're current at 1.08. I mean, you could call them fairly valued or just a smidgen over fair value right now. But if you look at this, one of the things you can look at, not only where they are at currently, but let's look at them over the last several years, or this last several months and quarters here. This goes back to December 2023, so about a year span here. And you can see currently 1.8, same as they were in December. Back in September 30th here, they were at 0.99, so just slightly undervalued then. More undervalued back in June of 2024 at 0.91, and about the same in March of last year at 0.98 as they were in September. So December 2023, you could have got them cheaper as well. So you could have got them a little bit cheaper all of last year, and then they've just tilted over to, like I said, potentially ever so slightly overvalued, but it looks like there were better opportunities here to buy them under their price to book under the 1 price to book here over the last year. So that is another way to use price to book. Not only can you compare this to other companies, and if you wanted to compare this to like a Bank of America, American Express, since they're another credit card company, something like that, Visa, for example, some other ones, you could do that as well. But using this price to book, not only can you compare it to other companies, but you can compare them to their self over time. That is how I use price to book. Now, dropping down, I want growing free cash flow over time, because typically if a company has growing free cash flow, they can do those things that we mentioned. They can pay down debt, make acquisitions, reinvest back into the company, pay a dividend, which they do, and raise that dividend over time, and buy back shares. Going back here to December 2021, you can see $11.6 billion in free cash flow, 2022, $12.8 billion, 2023, $19.6 billion, and 2024, $16.9. Looks like a bit of up and down, right? Nice steady growth here. Well, maybe not, because let's look at their repurchase of shares. $9.7 billion pulled out of the market in 2021, down to $4.9 billion in 2022. So it looks like their free cash flow went up, but they drastically reduced their repurchase of capital shares. So I'm going to call free cash flow up and down here. Same thing in 2023, down further in repurchase of shares, 718 million, but their free cash flow went up. So it looks like they're adjusting their buybacks based on their free cash flow. 2024 here, you can see 734 million, and free cash flow went down. So that's definitely down from 2023 to 2024. Overall, a bit up and down here, which is fine. But you really want to see nice steady growth, right? But this company is pretty old. Banking in general tends to be cyclical at times. Whenever the market's doing really well and people are plugging their money into savings, banks tend to do well, or taking out a bunch of loans. And then on the flip side of that, whenever we start seeing pullbacks and potentially entering a recession or in a recession, right, you start to see foreclosures, you start to see people not paying those credit cards down, right? So they're going to be delinquent on those. That's what really hurts banks in the long run. All right, jumping over to stockanalysis.com. This is another source I go to for information. I do recommend more than one source so you can make sure the information you are getting is accurate and up to date. Stockanalysis.com is another one that I use. Yahoo Finance was the previous page. I'm not affiliated with either one of these. And again, I do recommend more than one, two, if not 3 sources. 15 analysts have taken a look at this. They call it a consensus buy. Low estimate of $160. If it dropped down to that lowest estimate, that would represent a 3.17% further drop from where they currently sit. Average estimate of $204.53 would represent a 23.79% increase from where they currently sit. It's pretty close. It's 215, 204, pretty close, not too far off from what we saw with Yahoo Finance on the previous page. And if it happened to hit their high estimate of $257, that would represent a 55.54% increase, and that would definitely be a new 52-week high. I like to get into statistics, look at return on equity and return on invested capital to see how well the company is reinvesting its funds back into itself. I like 10% or better for both of these metrics. As you can see here, return on equity at 7.99%. Return on invested capital, not applicable. They don't have it. It's got to get 10% or better for both. This will not get a check for either, really. EPS growth wasn't listed, so same thing. I like 5% or better projected over the next 5 years. Not listed, can't give them a check there, though their revenue growth is forecasted at 12.55%. All right, let's look at their dividend history here. Quarterly payer, as we mentioned, payout ratio in the 20% range. Dividend growth not applicable because they are not growing that dividend. I don't like that. Buyback yield is negative. It means they need to be a little bit more efficient when they're buying back shares. I'd like to see them do it whenever they are undervalued. This tells me that sometimes they are buying them back fairly valued or slightly overvalued. Shareholder yield at 1.4%. Looking at their payout schedule, they do pay off schedule of most companies February, May, August, November. And they have been paying 60 cents for a while now, right? I don't even need to go through it all the way back to 2022, at least for the last 3 years, 60 cents. So no dividend growth there. All right, let's check the screener. There is not a lot of green there. That's not good. Understand the business. Check there. They're a bank, right? They're offering you a lot of the same services as other banks do. Online banking, savings, checking. You get your loans from them, a car loan, a home loan, business loan, that sort of thing. Credit card if you need it, that sort of thing. Growing free cash flow, no. They've been up and down the last 4 years. Growing dividend, nope. They've been paused since at least 2023. Dividend payout ratio is under 75%, so we'll give them a check there. Dividend yield theory says they're potentially overvalued. No check there. They are not within 15% of a 52-week low. No check there. Return on invested capital, return on equity, neither one is above 10% or 10% or better. Earnings per share growth not listed, so no check there. And price to book was just slightly over. Again, if you wanted to say 1.08 is fair value, I'm not going to argue with you, right? You could give them a check there if you want to do it. I like it under 1, though. It definitely wasn't under 1. It could be potentially fair valued, but it is not undervalued, at least according to price to book. So I'm only going to give them 2 checks, and that definitely does not meet the 6 of 9 I'm looking for. Let me know what you think of Capital One in the comment section down below. Is it one you're watching? Is it one you're waiting for more of a pullback? Is it one you are selling? Maybe you're part of the reason for the downturn today. Let me know in the comment section. Love to hear from you on this one. All right, here's a newer picture of what it looks like, what it actually looks like out back. This was from Saturday morning here. We did get a little bit of rain, but no snow, as you can see. The trees are actually starting to bud. It does look nice. Hopefully the water starts to get warm and we can be opening the pool here in the next month and a half or so and back out on the lake with the jet skis here in a few months. Hopefully it really warms up, but it's still a little cold, but it doesn't look like the snow we saw in our portfolio update video on Sunday. Doesn't look like that anymore. Well, as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. And drop a comment down below. Let me know what you think of the video. Let me know what you think of Capital One. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like Capital One you'd like me to cover in the Stock Pick of the Day video series, drop it down there, and I'll try to work it into the rotation on a day it pulls back. And this is Shane signing off. Wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great weekend. We will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion. Investment journey for educational and entertainment purposes. Investing involves risk. You can lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.